Hello, wonderful person. This is Chris for the Informed Stoner. It's Tuesday afternoon, time for our midday news report. This report comes from apnews.com. Powell to face Senate grilling on Fed rates and inflation. If the measure of the U.S. economy comes in hot, as it did in January, the Federal Reserve will likely have to raise interest rates even higher than it already signaled, and keep them there longer. Chairman Jerome Powell will likely warn in testimony to Congress on Tuesday. Let's hope that doesn't happen. We don't want more interest rate struggle. Ugh. Powell's first appearance before Congress in 9 months coincides with the recent signs that the economy remains resilient and inflation is still stubbornly high. In the past year, the Fed has raised its benchmark interest rate at the fastest pace in 4 decades, to about 4.6% in the highest level in 15 years. But consumer spending, hiring, and growth have yet to cool. Several Fed officials said last week that they would favor raising the Fed's key rates above 5.1% level they projected in December if growth and inflation stayed elevated. With the Fed raises its key rate, it typically makes mortgages, auto loans, credit card rates, and business lending more expensive. It's a trend that can slow spending and inflation, but also risk sending the economy into a recession. That is what we do not want, is a recession, which I know by the old terms, we're technically in a recession. I know they changed them, but we're pretty much there, and we don't want to go worse in a recession. Not at all. I don't want to experience that. I know most of you don't either. In his 2 days of semi-annual testimony to Congress, Powell will address his House Financial Service Committee on Wednesday. The Fed chair will have to navigate a treacherous path. He will likely be pressed by Democrats concerned with even higher borrowing rates that will tip the economy into recession, and Republicans who have urged the Fed to act aggressively to slow price acceleration. Inflation, as measured year over year, has slowed from the peak in June of 9.1% to 6.4%, but it's progressed stalled in January. The Fed's preferred measure of price increase rose from December to January by the most in 7 months, which isn't good, and it's making everything more expensive. Powell's noted that so far, most of the slowdown in inflation reflects an unraveling of supply chains that have allowed for more furniture, clothes, semiconductors, and other physical goods to reach the U.S. shores. By contrast, inflation pressures remain entrenched in the numerous areas of the economy's vast service sector. Rental and housing costs, for example, remain a significant driver of inflation. At the same time, the cost of new apartment leases is growing much more slowly, a trend that should reduce housing inflation by mid-year, Powell said. Yeah, we'll see. But the prices of many services, from dining to hotel rooms to haircuts, are still rising rapidly, with little signs that the Fed's rate hikes have an effect. Fed's officials say that the costs on these services mainly reflect rising wages and salaries, which companies often pass on to their customers in the form of higher prices. As a result, the Fed's monetary policy reports to Congress, which is published in conjunction with the chair's testimony, said that quelling inflation will likely require soft labor market conditions, a euphemism for fewer jobs openings and more layoffs. So they want more people to get fired, and they want less people to get hired. So that's messed up. And they also are talking about how with rising wages and salaries, the companies push it off onto the consumer. Well, of course they do, because no one higher up in those corporations are going to take a pay cut. They're going to push it on the consumers. And yeah. Anyways, nice loveliness with our economy. Hopefully it gets back to normal here in the next few years. I don't know. Optimistically, hopefully. Let's fingers crossed, right? Anyhow, drop a like and a subscription. Subscribe would be great. Thanks again. Have a great day.